Hello everyone. Welcome to our channel. In this episode, we will be talking about 10 key signs that a bank may be heading for bankruptcy. In this special report on the financial industry, where fortunes can be created and lost in the space of a single second. Today, we explore a subject that is sometimes veiled in mystery and misunderstanding. What happens when banks fail? This circumstance has often happened throughout history, leaving a path of destruction and disaster. So what actually occurs when a bank fails? And what red flags should investors be on the lookout for? By facilitating financial transactions, providing loans, and serving as a middleman between savers and borrowers, banks serves as the foundation of the contemporary economy. Banks can experience financial difficulties, which might result in bankruptcy. When a bank fails, it may have far-reaching effects on people's finances, the financial health of enterprises, and even the financial health of whole nations. Major banks have gone insolvent over the years, frequently following severe economic downturns. For instance, the Great Depression of the 1930s was largely brought on by the bankruptcy of major banks in the United States. Most recently, the financial crisis of 2008 was brought on by a number of big banks going bankrupt, which had a catastrophic effect on the world economy. Hence, it is essential to see the red flags that suggest a bank may be headed for bankruptcy. In this video, we'll look at 10 crucial indicators that a bank may be in difficulty and talk about what you can do to safeguard your financial interests. You may proactively protect your financial security and contribute to the stability of the banking system by being aware of these warning flags. So, let's get started. Before we start, I have a special request for you. Please take a moment to hit the like button and subscribe if you haven't already. Also, please share. Thank you for your support. Let's dive into 10 warning signs to watch for. Declining asset quality. Declining asset quality is one of the major indicators that a bank is about to file for bankruptcy. A rise of non-performing loans, a reduction in the bank's asset value, or a decline in the quality of the loan portfolio are just a few examples of how this could show up. These red flags may be a symptom of deeper problems, including bad underwriting procedures, a lack of managing risk, or even a struggling economy. High levels of debt. A further red flag to watch for is an increase in the bank's debt load. High-leveraged banks are more likely to go bankrupt if the value of their assets falls quickly. High debt levels might also make it challenging for banks to obtain extra funds if they need to. Investors should closely monitor a bank's debt-to-equity ratio as well as watch for any warning indicators that the institution may be overextending itself. Poor earnings performance. The effectiveness of a bank's earnings might also offer crucial hints regarding its financial stability. It may be a clue that there may be underlying problems that must be addressed and resolved if a bank continually reports weak results or struggles to turn a profit. To determine a bank's profitability, investors should consider indicators like return on assets as well as return on equity. Liquidity issues. Another major issue for banks is liquidity, and investors ought to be cautious when dealing with institutions who have problems with it. A rapid increase in bank withdrawals, a difficulty to access financing markets, or a drop in the bank's cash holdings are just a few examples of how this could show up. Banks that are having trouble with liquidity may be in danger of going out of business, which may have serious repercussions for the whole financial system. Regulatory issues. Regulatory problems may also be a clue that a bank is about to fail. A bank that is under regulatory scrutiny or is the subject of an investigation for wrongdoing may receive fines or other sanctions that might harm their ability to maintain a profitable business. Investors should closely monitor any regulatory concerns that an institution may be experiencing, since they may be a sign of more serious problems that might result in collapse. A weak economy. Investors should be mindful of the dangers connected with a sluggish economy, as it might have an influence on the financial stability of banks. Banks that have a significant exposure to industries like manufacturing or real estate, which are susceptible to economic downturns, may be more prone to financial difficulty. Moreover, banks in economies with weak economic fundamentals might be more susceptible to shocks to the economy. Management issues. Management problems may also be a clue that a bank is about to file for bankruptcy. High levels of senior executive churn or difficulty luring and retaining top personnel may put banks at risk of operational issues that might harm their financial well-being. Investors should closely monitor a bank's management team for any indications of instability or poor management. Capital adequacy. Another major issue for banks is capital sufficiency. And investors ought to be cautious when dealing with institutions that lack adequate capital. Banks that have inadequate capital reserves could find themselves unable to withstand losses in the case of a financial crisis or unforeseen losses, which might put them at danger of insolvency. To determine a bank's capacity to sustain losses, investors can consider its capital ratios, like the Tier 1 capital ratio. Market volatility. Market turbulence may potentially signal a bank's probable insolvency. Heavy exposure to volatile markets, such as those for foreign currencies or commodities, could increase the risk of financial difficulty for banks. Moreover, because of their reliance on short-term financing markets, banks may be more susceptible to market disturbances that might affect their capacity to acquire capital. Systemic risk. Last but not least, investors need to be mindful of systemic risks connected to a bank's possible insolvency. Investors should think about the possible effects of a bank's collapse on many other financial institutions as well as the overall economy, since it might have significant repercussions for the financial system as a whole. Investors should also be mindful of any possible spillover consequences that can result from a bank's insolvency. In conclusion, although they might not always be evident, warning indicators of a bank's imminent bankruptcy are there and may be found with a little searching. Investors can take precautions to protect their investments and avert the disastrous effects of a bank failure by closely monitoring indicators like declining asset quality, high levels of debt, poor earnings performance, regulatory problems, liquidity problems, a weak economy, management problems, capital adequacy, market volatility, and systemic risk. It is crucial to remember that while these red flags may be an indication of more serious problems, they do not always portend a bank's insolvency. Banks might be capable of taking steps to resolve these problems and strengthen their financial position. When investing in just about any bank, especially those that display any of these red flags, investors should exercise caution and do research. Moreover, regulators are crucial in preventing the hazards brought on by a bank's probable insolvency and safeguarding the financial system's overall stability. To stop a bank failure from having a greater negative impact on the financial system, regulators may take steps like bringing the bank under supervision, issuing fines, or assisting a merger or acquisition. So, there you have it. 10 key signs that a bank may be heading for bankruptcy. Thank you for watching, and don't forget to like, comment, and subscribe for more videos like this one.